the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show. I'm Ishan Gera. In this week's episode, we shall dig deeper into the government's decision on a longer tenure for public sector bank CEOs and MDs. We have an interview lined up with Swaroop Kumar Saha, MD and CEO of Punjab and Sindh Bank. Our experts explain UPI's AutoPay feature, and our consulting editor sheds light on the issue of bank profits and explains the nitty-gritties of the government's tenure extension decision. At the end of our show, we shall discuss the results of the last week's poll and ask you the question for our next poll. First, let's discuss the significant developments of the week. Earlier this week, a report highlighted that 10 trillion rupees worth of write-offs in the past 5 years have helped banks halve their NPAs. The announcement comes just a few weeks after banks announced another quarter of stellar profits. The performance has come on the back of robust credit growth amidst rising interest rates. However, this week the story that caught everyone's attention was the government announcing a 10-year term for public sector bank CEOs and MDs. Our experts delve deeper into the issue, explaining what the government can gain from the rule change. Aditya Puri was the managing director of HDFC Bank for 26 years. Shyam Srinivasan spent over a decade at the helm of affairs at Federal Bank, whereas Ramesh Sopti has served 12 years as MD and CEO of IndusInd Bank. Had any of these banking doyens served as heads of public sector banks, their term would not have exceeded 5 years. Since the BJP-led NDA assumed power in 2014, not a single CEO of a PSU bank has served a 5-year term. The appointments are generally made for 3 years, and there have been only a handful of extensions beyond the initial period. Furthermore, over the last 8 years, there have been several instances where the tenures of MDs, CEOs and executive directors have not been extended even if the candidates have been eligible for extensions. Consequently, the top management of these PSU banks hung up their boots before the official retirement age of 60. The government has decided to increase the term of whole-time directors in public sector banks to 10 years from 5 years. The decision, which applies to MDs and CEOs of PSU banks, is believed to be aimed at attracting younger talent to key managerial positions. According to a Gazette notification, a candidate can be initially appointed for 5 years and is then eligible to receive an extension for another 5. The new rules also apply to executive directors who occupy the position of a whole-time director. The government said that the decision to provide an extension after 5 years would be taken in consultation with the Reserve Bank of India. It still does not compare to the tenure at private sector banks. Last year, the RBI decided to cap the tenure of MDs and CEOs of private sector bank at 15 years. The latest step taken by the government would help state-owned banks not only hold on to talent but also build younger top-level teams which would have a longer time frame to execute strategies. In particular, reports said that whole-time directors who became board members around the age bracket of 45 to 50 years would stand to gain. Currently, there is a sizable number of whole-time directors at PSU banks who have joined boards at a relatively younger age. Another likely reason behind the government's step is the need to bring about continuity. Given that the banking sector is highly competitive, fostering continuity is crucial for PSU banks to stay abreast with their private sector peers. At present, there are 12 public sector banks in India. Appointments of whole-time directors in PSU banks are made by the appointment committee of the cabinet, which the Prime Minister heads. However, the candidates are selected by the Financial Services Institutions body, which is under the aegis of the Department of Financial Services. The body replaced the Bank Board's Bureau. It is not just the private banks which have witnessed an increase in profits. Most of the public sector banks have also crawled back to profitability. In a chat with Manojit Saha, Swaroop Kumar Saha, MD and CEO of Punjab and Sindh Bank, detailed the roadmap for the bank. Let's listen in to the conversation.
Hello and welcome to the Business Standard Banking Show. In line with most public sector banks, Punjab and Sindh Bank also reported healthy set of numbers for the July-September quarter, with net profit rising 27.5% to 278 crore. while asset quality has also improved. We today have Sharup Shah, MD and CEO of Punjab and Sindh Bank, to talk about the future roadmap for the bank. Mr. Shah, welcome to the show.
Thank you. Thank you, Mr. Shah.
Punjab and Sindh Bank reported a healthy growth in retail and MSME advances, 19% and 17.5% respectively in the second quarter. What is the overall loan growth target you are looking for the current financial year?
Yeah. We are, as far as earlier guidance also, when we finished our Q1 results, we had given an overall credit growth target of above 15%. In September quarter, we have done a 9.12%. So we stick to the guidance of 15% plus for the overall financial year. That is our guidance, and that will be driven primarily by these growth in the retail agri and MSME segment of plus 20%. We are targeting between 20 to 22% growth, and in the corporate segment, we are targeting a growth of 7 to 8%. So now we are at 9% plus. So we are keeping the guidance still on the 15% growth.
Was it a conscious strategy to grow corporate book much slower than the RAM book, the retail, MSME, and agriculture, because the portion of corporate in the total advances has come down on an year-on-year basis?
Yeah. See, a bank of our size with a advance of around 74,000 crores needs to balance its portfolio very judiciously. And therefore, in the past, when the bank was going through a cycle of high NPA and losses, the bank took a conscious decision to move away from the corporate, primarily corporate segment to primarily a RAM segment. So the earlier the ratios were at 55-45 in terms of percentage terms, in favor of the corporate segment. Now we are rebalancing that portfolio and making it a reverse, and we are intending to grow towards 55% of RAM and 45% of corporate advances. So that is what, because we are a very small in size in terms of the relative size in terms of within the public sector space. So we feel that we will grow qualitatively now, having come out of nearly 4 years of losses. And now that we have turned around last year with a good number of net profit of 1,039 crores, we want to maintain that momentum and maintain it in a judicious way going forward.
So what is the deposit growth target you are looking for the current financial year?
As of now, I'm looking anything between 10 to 12% on deposits. With a 15% growth in the credit side, I need to also balance my portfolio and looking into a 10 to 12% growth in the deposit side.
But coming back to CASA, in a rising interest rate scenario, don't you think it's very challenging to get CASA deposits, because people will like to more have their money in the savings deposit, because fixed deposit in the fixed deposit, because rates are gone up in the fixed deposit side?
Yeah, see, as an intermediary bankers, we provide the platform to a customer to open a savings account first with us, right? Now, if I suppose I was talking of the success story of the salary accounts. Now, a government employee maintaining his salary account with us, if I can increase the number, and if I increase the products with them, any customer, a salary account will do some mutual fund investment, will do some health insurance, will do some credit card business. Particularly if he is a credit card holder, he will maintain a minimum balance in his account to maintain his bills. Right. So these are the products which get integrated into a normal savings account, which lifts my CASA. So my retail term deposit will also plays an important role, but this is the operating expenses for which a customer maintains a savings account balance for his operating expenses.
Now, coming to the asset quality part, while asset quality has improved, but gross NPA is still high at about 9.67%. So one is, of course, recovery. You can beef up recovery to lower the gross NPAs. But apart from that, are you also planning to sell NPAs to NARCL?
We have 7 accounts identified amounting to 1,590 crores. So those accounts are under discussion. So that we hope some of them will at least get resolved, one or two in the current quarter, and maybe some will in the next quarter. So as the resolutions happen, I think everyone will come to know about it. So we are hopeful that some resolutions will get from that, and we also old NCLT accounts, which are where we are 99% already provided for. We expect some good chunky recoveries in those accounts. So that will also we have kept in mind while we are talking on asset quality. So we have brought it now to below 10%. Our guidance was in June quarter when we declared our results to bring the gross NPA below 10%. We have already brought it below 9.67%. So going forward, there's a lot of scope to further reduce it, and maybe we have kept a guidance of below 9% now. But if all the NARCL resolutions happen, maybe we can go below 8% also by the end of the financial year.
Mr. Shah, thank you so much for speaking to us. It was a pleasure talking to you.
Thank you, Mr. Saha. Thank you.
Thank you.
Saha said that the bank has set an overall loan growth target of 15% for the year, which the retail agri and agri MSME segments would drive. Another category that has witnessed spectacular growth is UPI transactions. The value of transactions has consistently been above 10 trillion rupees over the last couple of months. And now, with the likes of Google Play coming on board with new UPI features like AutoPay, it is further expected to accelerate. But what is the UPI AutoPay feature? Our experts explain in a Banking for You segment.
Google Play is the latest to join the UPI AutoPay bandwagon. It will enable customers to pay for their favorite apps and games, even as it helps developers transact with millions of users to build successful businesses on the platform. Introduced by the National Payments Corporation of India in July 2020, UPI AutoPay helps users make recurring payments. Customers can create recurring e-mandates towards mobile or electricity bills, EMI payments, OTT subscriptions, insurance premiums, mutual funds, or more. All this is for payments up to Rs 2,000. For payments exceeding Rs 2,000, the user needs to enter the UPI PIN. UPI-enabled applications have a mandate section where users can create, approve, modify, pause, or revoke an auto-debit mandate. They can also view past mandates for their reference or records. These e-mandates can be created through UPI ID, QR scan, or intent. The mandates are generated instantly, and the payments get deducted automatically on the due date, benefiting both consumers and merchants. The popularity of UPI payment systems can be gauged by the latest data released by NPCI, which shows that India saw 6.8 billion UPI transactions in September, amounting to Rs 11.17 trillion. This was an increase of 3% in volume and 4% in value over the previous month. But the real jump can be seen when compared on a year-on-year basis. In September 2022, UPI payments were up 86% year-on-year in volume terms and 71% in value terms. UPI transactions are expected to touch the 1 billion mark per day over the next few years.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
UPI has received a boost post-COVID, and so have the banking entities. Some experts believe banks have had a dream run, with each quarter better than the last. Our consulting editor and banking expert discusses the stellar performance of banks and whether the dream run can continue. He also sheds light on the government's tenure extension decision for PSB chiefs. Hi Tamal, thanks for coming on the show.
Thank you.
You've been writing about bank profitability every quarter now. The question that I want to ask is the merger of PSBs a factor in profitability of banks in India?
I mean, I don't think there's any direct correlation. Yes, I have been writing on bank profitability or bank earnings every quarter, because every quarter is better than the previous quarter. So it's pretty exciting time. If you see 3 years back, just before COVID, scene was very different. And despite COVID, this is a system which has been able to manage all the stress so well. It's wonderful to see. Has this consolidation contributed? Well, consolidation has given them scale, it cut down the duplication of business, etc. But I'm not very sure it has. We are seeing the benefit. We have started seeing the benefit because if you see with the microscope their balance sheet, the different parameters, public sector, most of the PSBs, barring a few like State Bank of India is a case in point. It's a pink of health when it comes to stressed assets, but most of the PSBs has far higher bad assets, both particularly gross non-performing assets. Even net after provisioning net non-performing is far higher than this. So they have not been able to get the benefit of scale as yet.
Now, bank profits are rising, but corporate profits are down. As rates rise, can banks sustain the dream run, especially as deposit mobilization has not kept pace?
One of the contributing factors of corporate profits getting down is, apart from the input cost rising, which is already high, raw material cost, their cost of finance also has gone down. Sorry, their cost of finance also has gone up because the banks have risen the loan rates. You know, typically banks are fast in raising their loan rates in sync with the policy rate, but they're slow in raising the deposit rates. As far as banks are concerned, there are two challenges, as you rightly said. Yes, deposit is a big challenge. What we may see is the stronger banks which have been doing well, they will probably tap the capital market to raise capital, and capital will give them liquidity to lend more. You know, that's one, but everybody won't be able to do that. So then either they need to rein in their credit growth, or they need to, at the same time, they also need to go to town to raise deposits. Few of them, they don't have the necessary expertise in the retail segment. But if you dissect, bulk of the credit in the loan is going to retail. Now, do they have the right kind of underwriting, risk management, and everything is in place? I doubt. So we need to see, these are the two big challenges. One is the quality of new credit. We need to wait a few years. Will some of the banks will end up will they end up burning their fingers? And at the same time, other challenges on the liability side. How would they raise deposits?
Now, because we've been talking about public sector banks, and this is something which is a recent news item, what is your opinion on the PSB CEO and MD term being increased to 10 years? Was it ever a factor in profitability of banks?
Certainly not profitability, but how a bank is run. Definitely, you need to see the tenure of the CEO. Now, if you look at the private sector banks, Aditya Puri has probably the longest tenure at the helm across the globe in global banking system. Now, but the public sector banks still, I'm talking about at least a decade back. There is absolutely no rule. Somebody was getting for 1 year, somebody was getting for 2 years, somebody was getting for 3 years, etc. Now, the shorter you have, the bigger the problem. There is no continuity and there is no responsibility. Other part is, which I wish at the next stage they would do, that why it should be capped at 60. Why not go beyond 60? For instance, if somebody is getting a tenure at 53 for 10 years, so let the person continue till 63. What's the issue? They have done it for State Bank of India, the past three, including the current one, they have exceeded 60. Now, why not you do this for even the banks, the competent bank? And the other part is this, let them not take it granted tenure is there. If you are incompetent, then you need to go. But our regulator does not bother much about the competence part. It's not a bank, but among the financial intermediaries, do we follow the same norm? Like as we speak, NABARD, which is a very critical institution in the entire architecture of Indian financial system, particularly for the agriculture credit norm. NABARD is headless for more than 3 months now.
Thank you. Thanks a lot for your time. We hope to see you next week again. Thank you. Tamal says that while the government has done well to provide a tenure extension, the sector needs holistic changes. RBI is great at detecting fraud but not at figuring it out incompetence. It needs to root out the incompetent CEOs and MDs as well. RBI may not be as popular in this regard, but it has not lost people's faith. Last week, we asked whether the central bank will be able to contain inflation below 6% by the end of this fiscal. 57.6% of the people believe it would be able to achieve this feat. The central bank has kept a target of 5.8% for the last quarter of this fiscal. This week, we would like to know if the central bank should also try to get the rupee under 80 rupees against the dollar again. Our polls open on Friday, and you can respond on Twitter, Instagram, Telegram, LinkedIn, and our website. Market corrections are helping buoy the rupee for now. The currency had crossed the 83 mark but is now below 82 levels. RBI will need to maintain a tricky balancing act by keeping inflation low, growth high, and rupee stable. We'll be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.